So we're happy to make a start, and usually this fireside chat is run monthly, and we normally have people from different parts of the world join. So Tim is one of the sponsors for this fireside chat. So Tim is based all the way in Tacoma, Washington. So it's been a regular attendee for a long time now. And we do have other people joining when they can. But typically our audience would be those starting businesses, students joining in, and just people. We do also have the founders and mentors. So I run this fireside chat as part of the events on the community that I host on founders and mentors. And founders and mentors is a pre-launch ecosystem for those at the very early stages of their business. So that's just to put that into perspective. Now we're going to kick off, and we're very glad to have Tommy on. Tommy is the managing partner of a private equity firm in London. It's called Beach Equity. And we're going to and one of the great things about the conversation today is that we're going to get sort of first-hand knowledge from someone who's in the business, to tell us how things are done and how things should be done. So I think this would be very enlightening for everyone on the call. So we're very happy to have Tommy on. Now, kicking off with the conversation, we usually would start off with trying to get a good idea of what the early life of our guest was like. What were the strong influences in your life? Did you always see yourself where you are today? And so that would be the same path we're going to take with you, Tommy. If you want to introduce yourself and just tell us about your early life and some of the strong influences as well, that would be great.
Okay, look, thank you for having me. It's lovely to join you all. So it's also hard to know how far to go back when someone asks you about your early life. I think just because in the way it shaped me, it's probably worth me going sort of quite far back. And that was, so my father died when I was very young, when I was 4 years old. So I grew up in a very tight family with my mother, my brother and myself. My mum was a school cleaner, and so sort of a lot of my memories as a child in school holidays were sort of helping her clean the school and things like that. So I don't think it's necessarily a classic background for a lot of my peers. But the one thing that I took from all of that was that it was drilled into me by my mother, and I'm very lucky to have had such an influential mother. So you talk about the one person who drove me, was her, and that was wanting to sort of achieve something more. From a family where no one had ever done A levels or anything like that. So that was a big influence. I was lucky that I was always very good with numbers. They've just always come very natural to me. It must be a genetic thing because I've got two young kids, 5-year-old and a 7-year-old, and they both have that same kind of ability. And actually at school, another driver of mine was, I'll be honest, I hated school. And that's probably not something that's great to say in front of a bunch of students. But I think it's a dangerous thing to get too caught in being obsessed with your studies. It's really important to be a rounded person, and sometimes you can kind of get lost in the education system. I think if you look at society and life, how many things are we still doing in the same way we were doing it 150 years ago? And education is one of those things. And so I think education is one of the areas, and we do invest in education technology, where surely technology has got to create a better thing. Things like this today are the next step of that, being able to talk to people all over the world, instantly, and those kind of things. But I definitely feel that we've got to be able to get more from technology when it comes to education. So yeah, I had a love of numbers. I didn't enjoy maths, I'll be honest, at school until I got older and I went to university. I loved my studies at university, and that's because a lot of the subjects at school are taught in such a sterile way, away from real life, the way you use them, and those kind of bits and pieces. But as much you need to get past certain things, you need to learn certain things. But I went to university. I studied astrophysics at university. I loved that. That's when I really got into things. But I never wanted to go into finance. In fact, it was a total accident. You have these influences when you're at university where you have the milk round. I assume it still goes on now. I don't know if I'm showing my age and this doesn't exist anymore, but all the banks come along, and they suggest you do these assessment courses and things like that. And frankly, I only did them because my friends were doing them. And the law for me into finance was actually a job in Amsterdam, if I'm totally honest. I was planning to go into research. I was planning to do a PhD. I had large student debt, and it was a way to kind of pay it off initially. So I fell into that. Had a brilliant first year out in Amsterdam. Unfortunately, I did very well, got promoted and transferred back to London. And we were trading at the top end of the market. So bonds, indices, things like that. And I'm just not very strong when my computer is my best friend. I like problems. I like really dynamic situations. I can do all the modeling and those kind of bits and pieces. I used to do it, obviously as part of my degree. It was a very big part of my degree, and it's a very big part of what I do day to day. But if that's the core of what I'm doing, it's just, yeah, the monotony of it. I don't mind doing it for a purpose towards a greater good and things that are going on. But frankly, I just really like people. I like interacting with people. I like chaos a little bit, which is why I invest in small companies. Our focus at Beach is definitely at the smaller end of the market. I do sometimes, wonder why when you kind of get through a day of total chaos. But actually, I love it, and so that's kind of what led me to today. So the big influence, my mother was a big one. I had one teacher who was probably the only teacher through my schooling that actually I really remember had a big influence on me. I've just always been very driven and just I've always followed what kind of I wanted to follow. And I think that's what's really important. Too many people fall into finance because they think they should work in finance, or someone has said it to them, and it's a pathway, to a big salary and those kind of things. Actually, modern society has shown us that, you can be successful in many different ways. And I think it's a wonderful the step we've taken away from that dependence on you have to go into a company, you have to go into a big company, you have to be part of a system. We're seeing entrepreneurs from all over the world in all sorts of ways, really fundamentally sort of changing the business community, how we look at things, disrupting things. And the fact I can be a small part of that as a funder is a privilege, frankly.
Fantastic, fantastic. Thank you so much. That's a very interesting, early childhood that you had there. So thank you very much for sharing it. And I do agree with you, the fact that and I do tell my students the same thing. People are too focused on the grades that they're going to get, and they sort of forget to enjoy the process of being in university, or forget to really engage in the process. And that's what I'd say, to be honest, the degree is not going to do too much. It's the skills you've acquired along the way. And sometimes I know they might, look at me and say, what she's saying, but that's just the reality of things. It's really how you engage in that process and what you learn along the way that I think matters. So I do agree with you. So thank you for sharing that. Now moving on, I do know that you're sort of one of the managing partners at Beach Equity. So it would be great if you could sort of tell us a bit about Beach Equity, what your investment thesis is all about, and just an overview. That would be very helpful.
Yes, so we set up Beach sort of 3 years ago now. So, but both myself and my co-founder have been involved in businesses sort of or investment most of my career. So I come from the investment side, and I'd worked for a number of different sort of big institutions. I've been in sort of US investment banks through to then smaller private equity firms. And the one thing that I've always found a bit strange is investors like to surround themselves with investors. And if you're investing in businesses, actually you need a mix of people who really have run companies. And I'd be the first to admit, I've not run a company. I can be very influential in certain areas of why companies can be successful, but I've never been there on the coalface. I've never experienced it. And I'd known Tom Billings, my co-founder, for about sort of 10 years at the point when I left my previous role and I was setting up Beach. We were having conversations, and it was so obvious he approached exactly the same thing. And we don't invest in anything unless we come to exactly the same conclusions, but from a different way. We will sit in meetings, and I'll ask questions on a certain point. He'll ask questions on totally, in another point. And sometimes I even wonder where he's going, with why he's digging into something. But then it all becomes clear as it all comes together. And I really think the mix of, if you can get that nexus of operator and investor, it allows you both to understand the company better, so you'll make better decisions. But actually, something that's been lost in the investment sector, I think, is the obligation of the investor to be supportive. When I say supportive, actually help the end result. So, this is just my personal opinion. I'm sure people would disagree with me, but just saying hire a consultant is not helping. Turning up to board meetings and asking the same three questions, once a month, once every 2 months, once every 3 months, however long board meetings are, that's not that's not really helping. So there's there's a real obligation, as I say, we're the investor to support companies, and Beach is absolutely built on that. So we won't invest in anything we don't think there's a clear way of where we can help that company. That can be from things like on our education technology investment, around stuff within the company, as well as some important introductions outside of the company, through to the investment we're completing at the moment, where we've compiled a board of absolute experts in the industry to support a CEO that we are helping dramatically increase the size of his business by buying a much larger business. So it has to be at the core. For us, we're looking at businesses, we're writing checks of 2 to 10 million. So this is very much the smaller end of private equity. We have two core strategies. One is a buyout strategy. So this is 1 to 3, 1 to 4 million EBITDA companies. Usually they're a bit tired. So they've been successful. I mean, these companies are making money, they're producing cash, but often owners have got to the point where they may want to step away from the businesses. There may be succession issues. People are, to be honest, people are tired. People who have survived financial crisis, which was brutal, have then gone into COVID, which was different. Was an opportunity for some businesses, but for most businesses was absolutely brutal as well. You add on to that, COVID has made a lot of business owners reassess what is important to them and where they want to focus their time. They've created real intrinsic value in their businesses, and they want to release that. So there is a massive opportunity in that market. But where we focus is where it's a bit hard and a bit difficult. So there are a lot of investors out there who want something they can just put some money in, they can sit back and not really do anything and make some money, usually put some aggressive leverage in there. We often see it from some of our peers investing in our market, putting 5, 6 times leverage into things. I get it. I'm not scared of debt. We do use some debt ourselves. But it's just unnecessary if you bother to do the work to improve the company yourself and support the development of that company. So the core set thesis is very sensible strategy. Obviously, you've proven product, proven market acceptance, given this company is profitable to a certain extent. And then what can we do? What can we take it on a journey? We always want to see that there is the possibility of quite an early exit. That's not because we want to take it, but we feel as though if you can create value and then you're going to be up potentially 2 or 3 times your money within 2 or 3 years, you've really underwritten the investment, so you can then take more chances later on if that is the right thing to do. So you've improved, you've created a higher intrinsic value that you're locking in. Then okay, we're working with the management team. Is it time for them to buy us out, or is it time for us to go on a bigger journey with them? And then we have a growth strategy. So this is companies which are break even, can be loss making to a lower extent, but could be break even if they needed to be. Again, proven product, proven market acceptance. We're not VC. We don't pretend we can guess which products are going to be accepted, which are not going to be accepted, because frankly, it baffles me sometimes. I remember seeing all the investments come in when Just Eat came in, and picking between the 10, 12 that we saw, they all looked exactly the same to me. But where we are strong, we do know how to support companies growing, how to support them taking that next stage, and developing further.
Fantastic. Thank you very much, Tommy. And I did make a few notes as you sort of spoke about it. And so some of the key things I drew out from there is the fact that you guys are looking to grow the company. And I think that that active investment, having the investors on board is something. And when you said investors like to hang around themselves, I talked about the conference where I met you, Tommy. And, one of the things that really felt very strange to me was that they're all investors there. Hardly very few entrepreneurs there. And so, as soon as you said that, that just came back to me to say that is very true. And sometimes it might just be the strategy that they're taking to just be passively involved in the business. Now, some people might argue that, a passive investor is equally good because it gives the sort of the entrepreneur their own room to do what they want. So what are your thoughts on that?
So there's time. So it's incredibly important that you match up your investor with your company. So some people just need cash. And I think as companies get larger, that becomes more the case. As your companies get larger, there's just a natural momentum about the company, and it becomes much more of a spreadsheet exercise, the investment. It becomes much more about the price of leverage. So, taking the biggest, PE investors in the country, so people like Carlyle, not picking on them whatsoever, but just as an obvious name, I imagine they're very sensitive to interest rate movements
Yeah.
uh, and things like that. So there is a difference there. But one thing I probably should have mentioned about us is, so the way we fund transactions is quite different to most PE firms. So rather than have just a fund where we draw funds from, we have direct investment. So people can access our investments on a deal by deal basis. And the people we talk to are primarily successful entrepreneurs who have taken money out of investments.
Okay.
So when we are saying we can help, it's not just myself and Tom. It will often be myself, Tom, one, two, three others. And when I say one, two, three others, these are people that have made 10, 50, 100 million out of a business in the same area and relatively recently. So someone who just wants quiet money, we are not the right person for them. We don't get involved day to day, and one of the biggest skills we have to have is knowing when to get out of the way. So and that's one of the arguments about passive investing. But if you foster the right kind of relationship with the team, and we have been there and done that many times with the companies as they grow, seeing the things that can go wrong, and we can just make sure we are building resilient structures around finance. We're building resilient structures around how the business operates, how it deals with regulators, if it's dealing with regulators. Preparing for sale is even a 3-year process of making sure every contract is perfect, everything is ready for DD. How do we keep our management accounts? How do we even want to grow? So we are just much more plugged into what a potential buyer of the business will want. So while the founder of the business may be very keen on growing in a certain area, we may point out, okay, we can grow in that area, that's fine. But if we become this type of business, we may sell at 4 to 5 times EBITDA. If we become this type of business, we'll sell at 12 times EBITDA. Are you sure you want to grow that area? Now, we won't dictate that, but actually you'll find a lot of the time people are growing businesses because they want to exit at some point. And we're very open about that. We will want to exit at some point. And that journey, say, can be 2 or 3 years, it can be 5 or 6 years. But when we can provide, we've learned from our mistakes. And it means the entrepreneur doesn't need to make certain mistakes that we can fill in for. And then equally, the people we're bringing in to support the transaction, you cannot hire them. Literally, they're just not available via. So if they're investing as part of the transaction and we're putting our own money on the line as well, then they have a vested interest in supporting the company. And when you get a couple of entrepreneurs together, there's a misconception. You get, sort of 2 or 3 entrepreneurs in the room, they're going to struggle to agree. It's not the case. Entrepreneurs are so respectful of other entrepreneurs. It's incredible. You don't get the same kind of clashes you get if you get 3 investors in a room who just end up arguing with each other. It's quite incredible, actually. They're very supportive. They're generally naturally good mentors because they've had to look after and grow a staff group themselves. So they're very good at mentoring the person that they're supporting, not getting in the way in the way some other people do.
Okay. Fantastic. Thank you. Thank you for that. Now, moving on to the next sort of questions I have. Now, it's just looking at the private equity trends. Now, I usually get updates from PitchBook, and some of the things that I've been seeing lately is, limited partners are sort of tightening their purses on, who to give, which firms to give money to and stuff like that. Do you just want to share your views on what you think are the key trends emerging in private equity at the moment? And if you want to sort of look at that from bitch equity perspective, I think that'll be helpful as well.
It's an interesting market at the moment. So it's hard to say definitively exactly what is going on in some areas. Also, it's hard to say why some of the things are going on. So what are we seeing? So at the moment, we're definitely seeing a lot of the names which have been doing a lot are doing a lot less. And that is both from seeing transactions go through, but it's also we talk to a lot of advisors and a lot of other people in the community, and they're, despite the fact that a lot of money has been raised relatively recently, a lot of, I think, the PE firms are sitting on cash with a view that they actually are going to have to bail out some of their investments. If you look at the vintages of 2018 through to 2022, I think it's fair to say that people paid far too much for businesses through that period, and there's been a real correction in value. It's hard to definitively say where that valuation has moved to. I mean, our view internally is that a lot of companies were masquerading as something that they weren't, and a lot of investors were happy for that to be happening because they were raising lots of funds and they were deploying lots of funds. And so, at the extreme, pretending Peloton or WeWork were SaaS companies. And that's why when you saw the sell-up in the market, so in the listed markets, there's everyone talks about, oh, there was this big sell in the market. It's like, well, actually, some companies came off a little bit and some companies came off a lot. And that was really exposing two things. First of all, the companies that were never really the sector they were pretending to be. And secondly, companies that were using a business model where it was always going to be very difficult to convert that to cash. And ultimately, it's not being corny to say cash is king. Businesses are there to make cash, and that's where the valuation is based. Obviously, with all businesses, and that got lost for a long time. I remember it was absolutely drilled into me early on in my career in the early 2000s, but it was very absent from many conversations that I heard. 2014, 15 through to 2020. So in moving back to that, I definitely think that part of the lack of cash being deployed at the moment is firms holding on to cash to bail out companies in their portfolio. They will want to raise further funds. And I think part of the problem of new funds being raised is people are really struggling to convince their LPs to give them more money because their LPs don't believe that their current vintages are where they're really being listed. So that's one thing. What else would I say? I think we will have interest rates. I think obviously the rates will be lower than they were at the moment. But I don't want to get in. It's a dangerous thing to get into making big calls around interest rates and things like that. I mean, historically, certainly, interest rates at 5% are not high. And so the fact that once we bounce around and settle, the fact that interest rates are, somewhere between, I don't know, and I'm not an interest rate expert, but somewhere between sort of 5 and 8%, it's not ridiculous. And actually as a cost of funds and a cost of money, that doesn't seem like a ridiculous level. So assuming we're not going to go return back to the near zero interest rates, it means leverage is expensive. Yeah. And that means if you are leveraging up investments, you have to do something in the meantime to cover that leverage. So investment firms need to get back to actually really adding value to the investments, really working with the management teams and being additive to that. And well, frankly, we love that because that's what we do anyway. So we feel that plays into our hands. And noting that we're expecting, 2023, 2024 vintages, so our first vintages to be relatively strong. We think it's a good buying time at the moment. If you're buying well, we've been very, very disciplined on the prices we're willing to offer for companies. We haven't been, I think I'm telling the truth when I say we haven't been the highest offer on any of the investments we've completed so far, but management teams have been confident to go with us based on the plan we've presented to them in terms of this is what we want to do with you, and this is how we will help you do it. And management teams either don't see a value in that, in which case, good luck, and go with someone else, or actually, okay, they do buy into that. And we're working with teams at the moment. We're just about to complete another investment, and it's absolutely clear where we're heading with them and how we are going to be a part of that. And so I think there is going to be a real return to where investment should be, where private equity should be prioritizing. That is the ability to support those companies, which I'm not sure where it got lost. I'm not an economic historian, but it got lost somewhere because I can't believe it's always just been based on leverage. Although if you read Barbarians at the Gate, which anyone who hasn't read it, do read it, and it'll scare the life out of you, where private equity used to be about sort of what was the biggest buyout for years back in the late 80s. Maybe it has always been based on leverage, in which case, then I think the world needs to change and understand there's responsibility there. What else? So this trend we're seeing. One of the trends we have seen actually a little bit, particularly at our end of the market, is recycling transactions. Investors coming out and going back into the same transaction, which has just baffled us. So exiting to someone, but then saying, "Oh, we're going back in alongside the buyer," and that's not financial engineering. What is?
I know.
And investors have definitely been guilty of those things in the past. But in terms of the trends right at the moment, we're quite excited. We did need a correction in pricing. Pricing was wrong. Interest rates, at 0%, is not sustainable and can cause all sorts of problems in an economic system. So there's a lot of opportunity out there. There's not as much money out there as is theoretically sitting in all the funds. I think LPs are definitely wiser to the fact they should be looking at investors who really can add value to the investments as they're going along. And we've had some very positive conversations about this. In fact, because we don't typically talk to the classic LPs, and we've had sort of several approaches based on some of the things we've been doing. And so I think that LPs are looking harder now for their partners and looking wider. And I think a trend you will definitely see over the next 2 or 3 years is a shrinking of the number of private equity firms, or certainly of active private equity firms. And those who were just sort of making up the numbers, whatever reason was that they were able to raise cash but haven't performed, will be shrinking out of the market.
Yeah. Thank you very much. And I think for me, the focus on companies that, focusing on other metrics, financial metrics other than cash. I think that sort of really struck me there, because cash is king, like you said. So when you focus on all these other things when companies are trying to raise funds, they are very creative with how they pitch. So, and if you're not focusing on cash, it's very strange as to what else to focus on. So I think that's one of the key things that I've taken out from what you've said there, and is one of the corrections that we're seeing in the market. So we'll see how that goes. But certainly, a lot of the things you said resonated very well. And those are the things that, when you read widely, these are, a lot of them are what you would see as to some of the key trends currently in the market. So thanks for that, Tommy. Now, moving on, again, just so that we know, this is a sort of a chat. So if you do have any questions for Tommy, please pop it in the chat. I will share his LinkedIn page so that you can connect with him if you want as well. So, and now carrying on, Tommy, we do have a few students in the room, and some of them would be international students who've come from their home countries to study in the UK. Some of them have not done any, summer intern at any of the big private equity firms. And so when you think about people who have not really followed the traditional way into private equity, what are the options or opportunities available for people that want to get into private equity, say maybe as a junior analyst and stuff like that, but might not have the opportunities to go through the traditional route? I don't know whether you have any comments there.
Yeah, so it's an interesting one, because what we look for, I don't think is necessarily typical of what other people in PE do. So I should be careful how I answer this. So at the bigger end, the larger companies, they do want to see robots, who have, kind of done 6,000 internships and 100 A levels, etc., and all that kind of stuff. And yeah, look, don't get me wrong, to anyone here who has an incredible sort of academic record, good for you, and if you've done, all those internships. But certainly for us, and I think there is an increasing awareness of this now within the PE industry, is first of all, don't go straight into it. And I don't think you can. I think it's quite naive when firms hire people, at graduate level straight into private equity. You need a few scars to work in private equity, because you need to toughen up a bit. I would like to think I was quite tough, but when you're kind of both scared and excited all day, every day, because you look at a company and, as much as you could sell it for 100 million, it might also go bust because you're low in cash. Certainly at this end of the market. I think the experience of either working in companies, running your own company, that's something we love to see, where people have tried bits and pieces. And by that, it doesn't have to be hugely successful. Not all of us are, natural entrepreneurs in great companies worth, 10 million or anything like that. I ran club events when I was at university to fund my way through university, things like that. Just bits and pieces where you just get some knowledge and awareness of what it's like, to have to actually win some customers, to service them, to look after them. I think accountancy is actually, it may be, be careful with saying this, so upset people. It may be really boring, but it's not a bad way to get some really good experience. So I did the ACCA. Rather than going into so I'd come out of investment banking. I didn't want to go into one of the big four and all that structure again. So I went to one of the more mid-market accountancy firms, which meant I did ACCA. It was great. Really good rounded experience. I spent 3 years in turnaround, which was really good as well. I spent 4 years in corporate finance before I moved to the investment side. And so I'm not saying you should do exactly the things I did, but it's about just learning and understanding companies. the notion that you are going to walk out of university having never worked with a company, around a company, worked around building strategies for companies, the numbers of companies, and be able to make an assessment of whether that company is right. The myriad of elements that make up a company, I think, is a bit naive. And I think if you go straight into an investment firm, you're almost never going to leave, because the structures of a lot of investment firms make it very difficult to leave. Around carry and all those kind of things. And I think that being careful again, I'm definitely not picking on Sequoia because they've been very successful, but we've all seen all the sort of succession issues that are going on there at the moment, and the public's back going on at the moment. That's because too many of the people went in there very young and they've never worked anywhere else. And if too many people are in the same institution for too long, everyone just thinks the same. You need rounded people coming from different places and rounded experience. So I would work. Well, what is it you're interested in? What do you like? Is there a sector you like? Is there something you like? If you're into sport, go and work for a sports company for a few years. Even if the pay isn't great initially for the first few years, do something you love doing so you learn some skills. Once you learn some skills, I think the biggest lie that's propagated by entrepreneurs who have turned themselves into influencers, not by the good entrepreneurs, and I very much separate them on that basis, is, you've got to follow what you love. It's got to be your dream. That's the biggest load of rubbish. Picking a small company, investing it is not the thing in the world I love the most. I love my job, but I love what I do because I spent a number of years getting very good at it. Once I got very good at it, you then develop an appreciation and joy in what you're achieving, and you shape that to what you want to do. And that is what you're doing. You're trying to get together a bunch of skills and you need to be patient. I mean, and particularly if you're not coming in with all those perfect things, because a lot of companies won't give you a chance. And that's, the cold, harsh reality of life. So build up that rounded experience and take your opportunities. You may have to go into, investment firm where your perception is, okay, I want to look, using Carlisle again, I was meaning about them earlier, so I'll be nice about that. I want to go into Carlisle, and they are a great firm. They're a great investment firm. But if you want to take the step to that, okay, what are the next 2 steps of my career that take me there? Okay, I need to invest 6 years to get there. What is the next role that allows me to get the role that will be the stepping stone to get there? But in me, you're talking to someone who's taken 3 career breaks along the way. Again, that's something I'm a big fan of when we're recruiting. We want rounded people who've seen the world, have met different people, who've had different experiences. We really value those things. We love it when people have tried their own ventures and tried to do bits and pieces. But I'd say I'm not sure we're typical in terms of how we hire. There definitely are firms like us, who have very similar ethos to us. I don't think they might mention people like True Capital. They have very similar ethos to us. They want very rounded people, who've done different things and experienced different things. But don't be in a rush to end up with the job that you're going to be in for the rest of your life. You want to do different things. You want to enjoy the journey. And you want to try different things. And as much as you can, travel the world. The best things I've ever done have been traveling around the world, and the people I've met doing that. And they really shaped me in a really positive way for what I do now.
Yeah. I think traveling is one of the best ways of learning. So thank you very much. I think what you said is very reassuring. And just the fact that, and it does make a lot of sense, isn't it? That before you go and start making decisions on how to invest in a company, it's good to know how they operate. And one of the good ways is to go into a company and learn how they operate. And then from there, you sort of can you can think of ways to improve a business because you've worked in one. So it does make a lot of sense. So I'm very, very happy that you said that, because sometimes people can feel overwhelmed by, there was a time I met this group of youngsters and they're telling me how competitive it is getting into private equity. You have to do this internship, you have to do this, you have to do this. I was like, okay. So, so it's really good to sort of hear your own perspective. And I think what has really helped improve the landscape as well is that there are a lot of new. So it's no longer just the old generation private equity firms or the big ones that dominate the market anymore. So we have younger private equity firms that are coming, newer ones that sort of would give people an opportunity. And I think they're like, for example, your company, your firm, Beach Equity, has a typically totally different recruitment ethos to some of the big ones. So I think that's very helpful there. Now, in moving on to the next question that I have, we're now sort of going back to your role at Beach Equity and trying to understand things better. Now, here I'm just looking at not necessarily just due diligence, but also thinking about when you make investments. I know one of the key things in your investment thesis is the value that you can add. But when you're looking at the value you can add, what are some of the things you consider? So I think what we're trying to better understand here is what do you look out for in a business that you want to invest in, that your firm wants to invest in? So like we said, one is value that you've talked about. Again, are there any other things that you think you look out for when you want to invest?
So it's quite different on the two strategies. So on the buyout strategy, so you sum it up in its most simple form. Yes, this is companies that are 1 million to probably 4 million EBITDA. So what are we looking for? We're looking for a solid foundation. So we are not looking for turnarounds. There are firms that specialize in that. Good luck to them. It's very difficult. I worked in turnaround, as I mentioned before, for 3 years. Once companies got so far, it's a very difficult thing to actually turn it around. And I think actually what they ended up doing a lot of the time is having to strip a lot away. And that's not what we do. We're growth investors. So we want to see something that we can use to grow from. So we want to see, okay, we've got a management team. We've got a couple of bright people maybe who need 2 or 3 more bright people around them. Okay, we'll help them hire those people. Using transaction we're doing at the moment, we've got a brilliant CEO who's done really well. He's grown his business to just shy of 10 million. We are supporting him, buying in another 25 million of revenue into his business. So it's going to be a big step up for him. One of the things he's definitely going to need is a very strong CFO who's got experience of integrating businesses, because he's going to be going through a big business integration at the moment. So we are used to that kind of hire. So we are very supportive in the process of finding that person. Another thing is chairman can be incredibly useful or incredibly value destructive. The automatic assertion that chairman add value. I've watched chairman destroy value almost for fun. Where it becomes this nepotistic gravy chain, it's a disaster. I remember one time being in a meeting back when I was working around investment trusts where one of the non-execs actually fell asleep during a board meeting. That kind of thing is it's beyond disgraceful. But where you can bring in an entrepreneur who's been through that journey, and not being through that journey maybe 30 years ago, but really been through that journey in that sector, and is about to exit. So the investment we've got at the moment, we've got someone who's been fantastically successful. They've grown their business to 180 million revenue. And now they are going to be the person who is mentoring Ollie through if he has any problems and things like that. And it's really important that relationship is really strong. So they've spent a lot of time together. They're both very comfortable with each other. We put forward people, we don't dictate them at all. So that's nothing. So building around that. Then around, okay, you need to be able to talk to the right people in your sector. So again, how are you going to access that? So is that building through the concepts that you have? Do we invest in the right people? Or for example, if you're looking to grow into an area and it's an area that's relatively new or in some way controversial, by controversial, I don't mean in the usual sense. I mean things around education. We talked about education earlier. Education is an area that people are very passionate about. So actually, how do we become one of the voices in that area which steers the way things are moving forward in a positive way? These are things we want to see our companies do, because then you're creating room to grow into. We don't just want to be an also-ran. Another characteristic we're looking for is, okay, at every kind of regular interval, is there a way for us to step away from this if it's the right thing to do? So as an investment fund, we're obviously looking for a return. We are very supportive. We believe we have an obligation to support the people we're working with, but we are looking to make money out of the transaction. So what we want to see is a structure whereby every sort of couple of years or so, there'll be the possibility that we can have a conversation with management. We're very open with management about this. Okay, where are we now? So is it that actually a couple of years in, we've made really good progress, and actually we've probably done everything we can do. So actually, would you like to buy us out at this stage? And that, or is it that actually there's a better investor out there to partner you, because suddenly you've got really large, you're growing really quickly, and you need someone who's pan-European and give you access to things we can't give you. Equally, is it that actually we've got to 2 years in, there's a much bigger opportunity here, and if we put a bigger check in, we can all go together and go for something much bigger. So it's about being very fluid about what you're doing. So. So I didn't notice before in the chat, Tim. So you asked a question as well, I think, about financial models, etc. So cash is king. I think, yeah, it'll appeal to some. Some people think it's a bit corny. It certainly appeals to me because it's the truest thing you can ever say about investment. Do we use financial models when to self? So financial models are an interesting thing. So every company looks great if you model it in the right way, and every company looks terrible if you model it in the right way or the wrong way. Very small assumptions can make dramatic differences to models when you're predicting out 3 or 4 years. So we do have a discipline on. We think it's really important to create models around the investments when we're investing in them, but we're not that bothered about checking against the model 2 years later. And the reason why we still model out 2, 3, 4 years is the discipline of thinking through all the variables. And that's what we actually care about when we're modeling. So having a proper conversation that, okay, you've assumed this over 4 years, why? Right. So you're saying we're going to be 95% of the entire market in year 4. Well, we're not, are we? It's that kind of sense checking, the logic of what are we doing? What are we trying to grow into? And also, what resource do we need? So if we're going to be that big, okay, we're going to grow revenues this, and we're going to be an 80% EBITDA margin business. Again, we're not. So what cost are we missing out? Because no business in the world makes that margin. So it's the discipline of working out of have we actually thought through everything. In terms of I think your question said when to buy and when to sell firms. It's much more around what's going on at the time. Private equity is very good at saying we have fixed time horizons. We invest for 5 to 7 years and all this kind of stuff. Well, it's nonsense, really, isn't it? Because were you going to sell last year? If you had a good company, it was doing well, why would you sell last year when valuation was massively depressed? So you've got to be very fluid about the market and demand as well as the investment. And that's why we're very open with the management team about having this continuous conversation of what might the exit be over the next 2 or 3 years? Should we be preparing for this? How should we be preparing for this? We spend time talking to target companies, and we encourage our CEOs to talk to the companies that might buy them. So we actively encourage those conversations to start 3 years before an exit might happen. And that's really, really powerful, because what you do, you get to a point sometimes where a corporate or even a financial investor might decide they want the company so much they'll offer far too much for it. We had this with an exit we had back in, what would it be, 2016 or 17. Back at one of my previous firms, where we deliberately seeded with a couple of people. We bought the company that was the top company in Europe at something. There was always going to be global consolidation in that market. And we'd seeded with a few people, that we'd potentially consider something if they came along. We didn't expect them to come along as quickly as they did. The entire investment journey on that ended up being a couple of years, which is really short for us. But the offer that came forward was so strong because they just didn't want the company to go to market and it to go to the other buyer. That CEO was positive about it, the full management team were positive about it, we were positive about it. So it's time for everyone to exit and go on to their next venture. So does that cover your question, Tim?
Yeah, I don't know, Tim. I think there's also so Tim is also asking within that question, the last element of the question, if so, what are the components of the model? So when you model these companies, you've said that it's sort of a way of sense checking. Tim would also like to know what are some of the components of the model that you do when buying or selling.
Extensive. We do create, even though we invest in small companies, fully integrated models, P&L, balance sheet, cash flow, and they are created from the basic units of what drive the company. So the first exercise in looking at a company in our mind, when you're just talking about the numerical side, is working out what are the 1, 2, 3 genuine critical KPIs. When we ask the KPIs, we always get a spreadsheet with 20, 30, 40, 50 numbers. So all of them are relevant. But actually, when you break it down, most companies are dependent on 2, 3 KPIs. And I mean here, absolute essential. These things work, we work as a business. These things don't, we don't. So revenue is not a KPI in my mind. Revenue growth is not a KPI. It's a secondary one that obviously you want to see. But what are the things you need to see on a daily basis? Is there a scarce resource that if you do not have, then you don't make, the better, great example most recently. If you didn't have semiconductors, I don't think a lot of us realized, how important semiconductors were in making cars. I mean, it's stating the obvious, of course they are. I mean, there's loads of semiconductors in cars, but a lot of people didn't realize that. So, that would be our access to that supply would be something that an owner of a car company should be looking at every day, and I'm sure they do now, and I'm sure they weren't at that point because they were too reliant on just in time. So once you understand the key drivers of the company, you then need to understand, okay, how does the business make its sales, and therefore how does that then drive into everything that we do? So we look at models around that, and they're more flows than they are financial models. But then we build our financial models from the base of what are the variables of the company. And then we want to look at scenarios around those things. So while we do a lot of work on this, just because we do a lot of work on this, we don't make our decisions solely on the financial model. We do a lot of work around commercial DD as well. So properly understanding the sector, properly understanding customer behavior, getting away from case study type answers. It's highly fragmented. Okay, a buy and build is a great strategy. So, well, actually, why is it a great strategy? I think that actually far too often people think buy and builds are easy. They're going to implement them. They don't work unless it's highly fragmented and there are a lot of companies for sale at the right price. If the sector trades at 6 times EBITDA and you end up paying 7 times EBITDA for companies because you're forcing yourself to buy them, you're not going to do very well when you exit. Things like that. So financial is one of, I'd probably say, so 6 core areas we're looking. We obviously do legal DD as well. Most of that's actually done externally. We do all of our financial DD initially internally. We do have external exercises, but that's just purely to verify our work. We do commercial DD, tech DD where it's relevant. You then have a regulatory compliance risk part as well, and depending on the nature of the business, that will vary. And then there's always a kind of ad hoc that, depending on the sector you're looking at, there's weird and wonderful things that are going on. So making sure that you understand those, and that is again all about drawing on the experts that are investing alongside us, and therefore helping us understand those bits that we just wouldn't understand as generalists. But I mean, our models are massive spreadsheets, of pages building up from inputs through to all processes. I mean, I'll be totally honest with you. My business partner is far better at this than me. I've got a lot of experience building models. He's pretty much banned me from building models though, because he builds them in a very structured way that's very easy to understand. And he regularly tells me I build models that no one can understand other than me. So, but I mean, it's a good thing. One thing I would say, if you, it may sound like the most boring thing. It's worth trying to build a fully integrated model yourself. To your students, honestly, try to get it work, set up a business, just make it up in your head and try and get it all to work and try and get everything to balance. It's a really, really good discipline of making sure you understand every area of the business and how each area of the business drives changes, because then you can play with it. Change things like debtor days. While debtor days bounce around all over the place in a small company because they're so small and they're so sensitive to things that are going on, you're still, what does it mean if it bounces around? And those kind of bits and pieces.
Yeah, fantastic. I think what has really helped there is, you sort of made it very practical to understand, and that's very helpful. So, Tim, I hope Tommy has been able to address all the questions that you've had. So we're just sort of 9 minutes away from the end of our session, our event today, and some of the few, I think we have time for one more question. Really is now looking at, so here we've talked about graduates. Again, we have students, and you've sort of given them a very good idea of what they should focus on at this stage in their lives. Now, I think the final thought will be for founders looking to raise funds. So you've told us what you look for when you're investing. For those founders that are looking sort of bring the business to a reasonable stage and maybe looking for planning to exit at some point, what should they have? What would you tell them to do as a bid to getting ready for investment? What are some of the tips you have for them if they're looking for private equity investment?
Okay, so obviously, it does vary depending on how large the company is, where it is, and what it's doing. On the VC side, the venture capital side, they are definitely looking to back an idea. Whereas once you're moving to the more PE side, they are looking to back a business which is operational, proven product, proven market acceptance. So you're looking at different things. So for us at our stage, do the work to make sure you can answer the questions that someone who wants to understand your business is going to ask. So a good CEO, there's nothing wrong with if someone asks you a really detailed question where you need a piece of data, then obviously, I'll get that data for you, is fine. Don't guess, don't get it wrong. But you should understand all elements of your business. You should understand your numbers. You may not be a numbers person. You may have someone who looks after that. Bother to take the time, though, to understand it, because you should be able to articulate your business in words and you should be able to articulate your business in numbers. It's just showing a fundamental understanding of a business, being able to articulate it in that way as well. You will create a bad impression when you walk into a meeting and you think you're just going to blag stuff. We meet, I don't know how many companies we meet. Probably meet 5, 6 new companies a week. So what's that? Probably meet over 200 companies a year. The investors know when you're just trying to blag it. I know there's some sort of very high profile stories of people who managed to blag their way into committing fraud in the US and those kind of things. It's rare, and you're going to get found out somewhere in the process. So be ready for it. Do your research and actually be able to articulate your company in a very, very simple, short way. Your initial sell should be 2 or 3 minutes. Then there's a secondary sell, which is much more detailed. I would suggest actually in meetings, try to draw the investor into a conversation as quickly as possible. I don't know how many people here like being talked at, and this is probably me being very hypocritical, having sort of talked to you for the best part of an hour, but I can't sit there and be talked at for half an hour. So preparing a half an hour presentation, everything you say after about minute 4, I would have switched off because I'm just not very good at paying attention. So you've got to cater to me, but you've also got to cater to the person who wants massive detail. And the way you deal with that is forcing that interaction of turning it into a conversation. So it becomes very clear if someone is asking you for massive detail, have that detail, be able to discuss that with them. But equally, be able to talk about your company at a high level and actually draw into what can you give me as quickly as possible. Don't walk in the door and just say, what can you give me? But explain your company, see, right, okay, has this resonated enough that they understand the business model? Is that as far as they want to go before they want to have a conversation about their specific questions? As quickly as possible, get to their questions and cover that. And then as quickly as possible, get then to the part of, well, how would this work together? How do you see this working together? What can you add to me? If you're just looking for money, make it clear that you're just looking for money. If you're looking for someone to be additive to your business, make that clear as well. And then spend the time, if there is a positive meeting, make sure. It's very easy to grab at money and it's very easy to grab at the best price. And I understand this absolutely equivocally. I understand, but you are going to be stuck with that person for 2 years, 3 years, 4 years, 5 years, 6 years. That's a long time. I don't know, but I'm pretty sure you get divorced a lot quicker than that. So marriage is actually less of a commitment than joining an investor. And you're at work more than you are doing anything else. So you are going to have to live with them day in, day out. So make sure you are really, really comfortable with them as people, that you share values. How are they going to react? When things go wrong, is it that actually you want to have a very somber relationship, almost that debt-like relationship, and we'll just meet once a month? Or is it that actually the first person you call, is that investor? That's the kind of relationship we have with our investors. We had it with one of our investments where it was one of the large ones we did. A large company was already turning over 24 million when we invested, and they lost the contract. It was 8% revenue in the first 6 weeks. It wasn't their fault. And so you had a conversation with the CEO. He was extremely worried, assumed the reaction was, well, we'll have to cut this, we'll have to cut that. It's like, well, look, we need to think about this. We asked for some information. He went away, was actually convinced, because even though we had a good relationship, we developed over time, but he'd been, he'd heard some stories about, our reaction would obviously be to sort of to cut things. Our suggestion actually the next day, and this is not always the solution, I'm not suggesting this was the solution, was, well, actually, if we gave you a bit more money, we can cover the cash flow this is going to cause, because we're not going to be able to rehire these people. And it was a real niche skill in terms of the industry that we're in. So if you can have that kind of relationship with your investor, and that's what you're trying to find out, you're trying to find out as much as they're trying to find out. I mean, the thing it's akin to actually is, I don't know how many of you have interviewed people. It's not until you interview people, you realize that being the interviewee is probably easier than being the interviewer. Because I remember having gone to lots of interviews and it was really scary and you're very nervous. And, if you're like me, I do get very nervous when I first meet people, despite the fact, I love being around people, etc. And actually, once I started interviewing people, it's like, as the interviewer, you're desperately trying to find out information. You just want to find out how people fit. And it's the same with investment. You have to think both of you are there to find out stuff about each other. And as soon as you see it as an equal relationship, then I think you have a much more productive meeting.
Thank
Does that
you. Thank
cover
you.
what to
Yeah.
focus on? Yeah, sorry,
Yeah.
I'm conscious of time as well.
Yes, yes, yes. It's very good. Thank you very much. Thank you very much for that. So what I'm going to do, I think I was very, very clear. It's now time for us to do our giveaways, and I'm just going to do a spinner now. I'm going to share my screen, and then let's make sure this is open. Share this. So we have currently 60 people in the room at the moment. So we're going to do the spinners for our 2 Amazon vouchers. So I've managed to get all the names on the list. So I'm going to do the first spin. Okay, so the first person is Tony. So Tony A. So I just put an abbreviation for the surname. So Tony, if you could put your name in the chat and your email address, and I'll get in touch with you after the Fireside chat. So spin the next one. So we have the next person is James Bennett. So James, if you could please put your name in the chat, not your name, your email address, and that will be very helpful. Now, I don't know if we have any Americans in the, so other than team, I don't know if we have any other American in the chats or on the call today. I don't know, well, I don't think so. So we'll just stop it there. We've gotten our 2 winners for the Fireside chat today. Tony, so let's just give me a few. Let me make sure. Let me see. Tony Arnold. So Tony Arnold, if you could please put your name, your email address in the chat, that'll be helpful. And James Bennett as well, please put your email in the chat. So thank you, Tom. I'm just mindful of time. I don't know if you want to just leave us with any quick final comments, and we'll round up the conversation for today.
For me,
yes, Tom.
yeah, sorry. Yeah, look, thank you for listening to me. Sorry, I probably go on a little bit. Look, if you have any questions, obviously pop them across. But look, ultimately, for all the students out there, the next 10 years of your life are time to gather experiences, to just have fun, focus on just having fun on the journey. Naturally, things will come together. You'll become stronger in certain areas. You'll find those out. You don't know what they are now. I know you think you do, but you honestly, don't worry too much about your career till you get to at least 30. And then you may still want to go into private equity. If you do, then that's the time, having gathered a load of skills together, to then really focus, on your career and moving forward. But it's a myth that people absolutely, you go into something you love when you're 20, because frankly, the stuff I loved when I was 20 and the stuff I do now are totally different, and it's the same for all of my friends. So good luck on the journey, and just surround yourself by good people who are always helping you move forward and learning more.
Thank you very much. Thank you for that wonderful advice, Tommy. We're very appreciative of your time. So thank you. Once this is the recording is edited and ready, I'll send you the link. So thank you everyone for taking your time to come in today, and I'll let you know when we have the next Fireside chat. So bye everyone.
Thank you.
Bye, Tommy. Bye, Simon.
Thank you, Tommy.
Bye.
Bye-bye. Bye, everyone.
Bye. Bye.